Very good evening to everyone. Welcome to 22nd Annual Marine Money Week Asia Conference. Today's panel discussion, Improved Fortunes in the Tanker Market. I'm joined by Aksel, joined by Alan and Anoop, and I'm Harmeet, Bhatia, moderator for this panel. One of the prevailing topics of discussion in today's tanker market revolves around the extent to which the withdrawal of Russian oil has affected the Western markets. Have the high rates observed over the past 1 year or so vanished, or can we anticipate further developments? What are owners contemplating in terms of new builds? Our panel aims to provide some insight into these questions. So before I start, I'll just give you a timeline on the Russian war and the sanctions and where we stand, so everybody has the right perspective. So Feb 22nd, Russia invades Ukraine. March, oil prices surge. April, Western countries impose sanctions on Russia, energy sector targeting exports, financing, and technology. December, the coalition enforces a price cap on Russia. 23 January, Russians basically increase the capacity by 300,000 barrels per day, go to 8.2 million barrels per day to supplement their war chest. In February, G7 nations enforced a price cap of $60, whereas the Brent was trading at 83. August, sharp increase in crude prices. In retaliation to OPEC cuts, Saudi Arabia and Russia jointly reduced production. What started as an economic statecraft by G7 has resulted in the creation of an ecosystem to circumvent the price cap. We are unclear of the exact impact on Kremlin bleeding, but for sure the implications on the tanker markets are too early to predict and will create more uncertainties along with complications in coming times. Now on to the first question. If we look back at all the cycles, all the spikes in tanker markets in the last 10 years, probably 2015, 2020, 2022, these are the couple of spikes which has happened. Which in your opinion would have been the biggest spike and by far longest lasting?
And we could contribute from there. So spike by definition means up and down. So it's hard to say, well, what's a long-lasting spike? But I think the longest lasting up cycle so far, in my view, was 2015. It was built upon something which was, from a demand side, quite supportive. Shale was the new kid on the block, lots of exports from the US. China was doing very well economically. They had a massive stimulus in 2015, and it was a very oil-intensive stimulus. And we went into that bull cycle on the back of quite a small order book, 2013, 2014. Didn't have too many ships delivering. So I think 2015 was the largest, was the more fundamental bull sector. And now we are at a stage where it's a war-derived dividend. And on the order book side, enough speakers have sort of extolled the value of a small order book.
So is it right to say in 2015 only the crude markets benefit, or even the product tanker market benefited a lot?
Yeah, I think it was very much driven by the crude tanker side of things in 2015.
What really triggered the 2015 spike?
The 2015 surge was triggered by a war between Saudis and the US on shale production. So the Saudis said, well, we're going to fight shale by increasing our supplies as well. So shale was increasing, and the Saudi supplies, OPEC supplies were increasing. So there was that much amount of oil which was moving long distances. The oil market was in a massive contango.
But don't you think, Anoop, the 2022 cycle, which probably started in Q2 of 22 and has lasted till now, probably second half of 23, has been longer than 2015?
So I think the 2015 cycle was a 2014 sort of second quarter, third quarter, fourth quarter start. And we had reasonably good earnings into about 2017 mid. And then, we had the supplies delivering, tankers delivering, and then again we had a bit of a surge up through 2018 second quarter. So I look at that from a 2015 to a 2018 kind of a cycle. Yeah. not a spike, really a cycle. And eventually, the deliveries that we had were 16 and 17, sort of killed the market.
True. That's an interesting answer. The next question, we would talk about new builds. Probably, what are the economic drivers for new build orders with LR2s reaching 17 million in Korean yards and 65 million in Chinese yards? Of late, we have seen a lot of splurge and hype on new builds, especially on the LR2 sector. What is the outlook going forward for them?
I mean, I'm by no means a shipping or oil market expert, being a CFO at SFL, but we have a fleet of some 13 tankers that we've chartered out on long-term contracts, and of course we view a lot of projects, be it new buildings or kind of second-hand tonnage. I think while we are fundamentally very bullish on the tanker sectors and the fundamentals, I believe a lot of speakers have talked about the order book, which is, I mean, it's very obvious. But then also you have to talk about kind of why is this, what's driving the lack of new buildings, and why is it interesting to invest, right? I mean, you have the dilemma of what's the next fuel. I mean, that's kind of been made a lot of ship owners sitting on the fence for a long time. I think also the fact that there's a fundamental lack of risk capital in the capital markets over the last decade compared to the decade before.
Yeah.
That's basically not been funding speculators. I think also banks have been kind of reducing their exposure to shipping while they're now building up again as shipping is booming. That's also been an effect, and of course ESG. But I mean, if I look at the prices today, I think VLCCs are quoted 130, 140. I mean, that is historically extremely steep. And if you look at, call it break-even rates going forward, I mean, you're $55,000, $60,000 per day. On the life of a VLC, that's high.
How many years? What cycle? 15 years? The earnings, what you said about LR2, say 70 million.
This is on the VLCC. So then if you look then to what to then, or is it more attractive to do Suezmaxes or LR2s? I think that equations makes more sense, because I mean, it's still pretty steep to pay, call it 70 for a new build, but I think you have more versatile ships in terms of flexibility going forward. I mean, if we don't know how long this Russian conflict will last, and of course that's impacted kind of trade routes, ton miles. I mean, VLCCs have more traditional patterns. I think 2 or 3/4 are basically of cargoes going out of the Middle East, but new cargoes coming from South America, etc. There's more flexibility in that type of vessel. So if I had to basically put a bet, I think it would be on those assets. Although expensive, I think it could be an interesting investment.
See, in all the spikes after 2015, probably the 20 and the 22nd, only time we see right now a real hyperactivity in new builds. I think in the previous spikes, we never saw that. What do you think, Anoop?
I kind of disagree on that, because 2015, the surge in earnings was followed by 3 years, 18, 19, and 20, where you had close to 50 VLCCs delivering every year. So
Interesting.
it is, ship owners do what ship owners do best, whether it's the container segment, whether it is the tanker segment. A period of sustained solid earnings fills the coffers. And I see, to your point about LR1s and LR2s being a good investment, obviously the ship owners have bought into it. So you have a clean order book for the LR2s, which is about 20% of the fleet on water. So yeah, it is, so that to me is a bit of a question mark on how long and strong can any real shipping cycle be, especially when the global demand environment isn't very supportive. It's easy for ship owners to build into it and cap the duration of any sustained upcycle.
True.
Just a small comment. What I also see is that, I mean, I agree. I mean, the world is uncertain. I mean, recession is looming. But if it's also kind of the replacement need of these. I mean, if you look at Aframaxes, I mean, I think the uncoated Aframax fleet, I mean, 44%, almost 50, is more than 15 years old. So you will have to.
Huge numbers.
You need fleet renewal.
That's interesting. Good share. Alan, what do you think the rising crude oil prices, a global slowdown in manufacturing and higher interest rates means overall for the tanker market?
Thank you. A couple of points on the other things that were raised as well, just quickly. One, I think, kind of looking at historical spikes, as you've mentioned, and historical changes in market. I'm certainly of the feeling now that we're in a multi-year kind of boom, really, for the clean. I think if you look at lots of the different fundamentals that are around the order book and various other factors that are there is a very strong story around the next 2-3 years, just through tensions in supply and everything else as well. So I think we're probably set for a better run than we were in 15 to 18. Onto the factors that would affect investment at the moment. I mean, I think all of the factors that you've raised are important. I mean, obviously we're in a higher interest rate environment, but I think historically, we've always had to make shipping investments work between 5 and 8%, something like that, and we're not a million miles away from that today. And if an investment doesn't work at that level, then maybe it wasn't the right investment. I think rising oil prices has an impact on cost, but also it feeds through in different ways. Much more important to some of the markets are refining margins and crack spreads, and therefore production and supply into certainly the clean side of the market. I think probably the most important factors that we've seen and that have had the most profound effect on our markets have been geopolitical. And so all those other factors that you've raised, if you look at really what's affected the pockets of investors, the decisions of owners and operators over the last few years, it's been what's happened in Russia and Ukraine. And so, we can cite all the things we can see on different curves. We can say the order book looks small. We can say, that we think this is going to happen on an output and refining capacity and crack spreads, etc. But really, we're in a very interestingly poised world at the moment with geopolitical tensions in different places and no real clear answers on a lot of those questions. And so I think that's one of the key things, as well as kind of regulatory and environmental concerns that inhibit a lot of investment, is that uncertainty, but it also creates a huge amount of opportunity.
What do you think probably is the biggest repercussion or consequence of this war? Is it probably a lot of new trading patterns, oil flows creating, which were never basically seen by any of the conventional tanker owners? What do you think, Anoop?
Yeah, clearly. I mean, that's one, that you've got phenomenally long flows. Other is the bifurcated markets. Right? So now you have a very large market for just sanctioned trades, which obviously in a conventional upcycle like we saw in 2015, that was not the case. Yeah. And that has two consequences. The bull side is clearly that you have long haul flows. But the bear side is that 40% of the Afra fleet, which is 15 years or older, will not retire at the ages it used to retire at. So you will continue to have 23, 24, even 25-year-old vessels, because India takes up to 25, available to trade. Yeah. So I think the Russian war on the prompt is very, very supportive rates. But the longer it goes on, right, the longer you have a very clear divergence between what trades in those markets and earns very good money and what trades outside. I'll just take you back to not very far back, 2019. Ships in the Iranian trade, who were captive to that trade, were earning $60,000, $70,000 a day, VLCCs. VLCCs in the mainstream trade were earning barely enough to wash their face, right?
Very interesting. So will it be right to say that after the start of the war, we have an ecosystem which is good enough to support the sanctioned trade, and those ships won't probably come on this side of peripheral and we won't go on the other side of the peripheral?
Yeah, I think outside, sorry if I'm hogging this space, outside the mainstream outside the Russian business, right, the mainstream business, to me, that's got more headwinds than tailwinds today.
Anything you want to add?
Well, I think the other impact that we can't underestimate, as I touched upon, was regulatory and environmental, and the much kind of greater need to keep the fleet modern. And so, as much as we think that some of the ships will keep running, if they do have to exit that kind of bifurcated market, if they do leave the shadows, if you like, then there might not be a place for them anyway. I think you'll end up having a situation where the order book, which is still small by historical standards, has a very good chance of getting absorbed.
So, next question I would ask is, how many conventional tanker owners are investing in gas, especially in LNG sector? Is that the reason for lesser number of new build VLCCs?
I'll try to answer that one. I think, at least when we do investments, we look at a lot of focus on counterparty, but also on the residual value of the ship. LNG vessels are extremely expensive. VLCCs as well, but I think in the long term, if you consider the energy transition, I think LNG has a stronger card than VLCCs long term. And eventually, we'll try to be less dependent on oil. So, of course, if I was to bet long term, I think I would rather go long LNG than long VLCC. I think that's at least kind of a very top-down answer to that, yeah.
I agree. I have seen LNG rates on the spot market as high as 350,000, 400,000. But I've never seen VLCC rates more than 200,000. And obviously, LNG life cycle of the ship is longer. So that's interesting.
Hypothesis why ship owners are not, VLCC owners are not ordering VLCCs is because unlike the product tankers and the Afra Suez, VLCCs haven't seen a sustained upturn. They've seen ups and downs, but you haven't had a rateable upcycle, so to speak, on VLs. Especially on the 2022 cycle, it was mostly the Aframaxes, Suez, and the products reaped the benefits. VLCC saw very little of it. So coming back to we are probably at the end of Q3 23 now. Everybody's quite bullish, and the tonnage is quite balanced. What can be the unexpected right now as we go into Q4? I think on Q4 we are not particularly bullish on the Vs going into Q4, and our expectation is based around the fact that China is sitting on so much crude inventory. The crude onshore stocks in China are as high as they were when oil was trading at $40 a barrel, April 2020. Because China has just hoovered up so much crude, partially on misplaced expectations about future demand. Right? Not really an opportunistic build. So it's a build where at the start of the year you had very fancy expectations on where Chinese economy would go. The long and short, though, is that China is sitting on more than 1 billion barrels of crude oil in its stocks. And there is a fairly sort of transparent relationship between the price of Brent and the inventory levels and the inventory growth. Price of Brent falls, inventories rise in China. Price of Brent rises, inventories fall. So, and we're looking at a very high crude oil sort of price environment for the next at least 4, 5, 6 months. So we would think that China would draw down stocks rather than import crude. So that's one bear factor for the VLs in our view.
But off late, we have seen Chinese exports very busy on the MRs, LRs, and they have been the main drivers of North Asia, which has been probably one of the best performing MR markets of late. How do you, basically, it's a balancing down, right? The crude inventories are going fast in the refinery processing. And this is the same thing what they did back in 2020.
Last year.
Last year
They did.
Every time they expect a dip in crude prices, they increased exports.
The difference between last year and now is that China is buying so much more Iranian and Russian crude. So which is why we are very bullish Suez and Afra. We are very bullish product tankers. We think product tankers will have a stellar winter. And so will Suez and Afra, because there's a lot of that trade which is coming back and sort of helping up that segment. But on the VL side, where we think China will put a real pause on incremental export.
What do you think Iranian exports stand at? 4 million, 5 million?
2 million crude exports.
Russian?
Russia is doing about 3.6, 3.7.
And probably after the war, how much exports America has picked up? From 8 million, they're up to 13 million?
In terms of crude, right? In crude, they have picked up, I think, about 1 million barrels a day. But the interesting thing on the US side is that all the main crude production basins in the US have been in net declines since May. So Permian has been declining, Eagle Ford declining, Bakken declining. And so the incremental growth that has driven the US exports has been inventory drawdowns on the SPRs and commercial inventories. And that's hitting levels where there isn't that much residual left for more exports out of that.
All right, next question for you guys. In recent months, we've seen a lot of tanker owners selling overage tonnage, rather operate in the spot markets. What are the reasons behind this, and what will be the implication on the tanker tonnage supply, especially for non-Russian or non-sanctioned barrels?
I'll take that one. Look, I don't think it's necessarily about Russian or non-Russian barrels. I think it's much more about being at a point in the market where it makes sense to take some length, to take some risk off the table as well, even if you're bullish. I mean, I think if you look at what the investment point was for a lot of the ships that are on the water, you can still make a very good return by taking some of that risk off the table. And I think just as we were talking about investment decisions being made and people looking at investing in new builds, you know, the listed companies at the moment are very committed to returning to shareholders, are very committed to showing banks that they're going to be paying down that debt. Not that they really need to show the banks that these days as much, but certainly giving themselves good forward pipeline cash flow as well. They've already got some inbuilt risk that they're going to not put everything out in that kind of way. But I think key is keeping that dividend going and keeping the share price rallying as they have done, and going through, as we saw before, up to, you know, kind of 0.9 and maybe even through that NAV hurdle that we never really quite get through very often.
Maybe I also comment on for SFL, for example. I mean, we do long-term charters. That is what we do. Time charters to end users, and I mean, they have certain age restrictions on tonnage they take in on long-term charters. So for us, when a vessel comes 13, 14 years old, it's time to divest and recycle that capital into new modern ships, because that's, I mean, we can trade them in the spot market at some time and then wait for a great market that we see in the last 12 months and then exit. But for us, kind of securing those long charters that we like, that's not feasible for tonnage of that age profile.
If I were to say that the Russian-Ukraine war will end tomorrow, what will be the immediate implications on the tanker market?
It's interesting. I think short-term implications might not be that dramatic. And it probably will depend a little bit on who comes into power in Russia and what is the geopolitics around that, right? But if the war ends tomorrow, the natural state of equilibrium will return, I would think, at some point in time, where more and more loopholes emerge within policy, which drives crude trade voyage volumes, voyage lengths, and product voyage lengths down again, right? So I don't think, despite the fact that the order book is small, if we lose the motive power behind Russian exports going long haul, then I think the markets will soften. And we saw that. We saw that in May this year, when Russian product exports fell. You had a really poor market across the entire product tanker segment. Yeah. So yeah, that's kind of my long and short answer to that.
Very depressing answer. Any inputs from you guys?
I mean, I think my view would be that things don't change back to where they were overnight. I mean, I think the mentality in Europe and elsewhere has changed in terms of energy security and where they source energy from, and that's going to have implications and mean that the trade flows that have now been developed remain for some time at least. So, I mean, I think it would be it would not make a huge difference overnight, and that the market wouldn't fall dramatically overnight. I think there might be some changes, but I think overall, you know, the sanctions are unlikely to be lifted immediately, and that's really what's been driving the rates that have been much more buoyant.
Interesting.
Perhaps we might even see a return of the sort of shadow fleet into the mainstream fleet, if the war was to end and sanctions ease off. So that's another downside risk.
It'll be easy migration back to the mainstream?
What do you think about that?
I think it's a long drawn process, and some of the age of the shadow fleet is probably on the overage side. It'll be a very difficult process, and probably immediately returning to mainstream will take time, like what we saw in the Iranian fleet and so on.
I think from an age perspective, from a vetting perspective, from all the different hurdles that other charterers would require, I think that's an issue as well.
One of the main repercussions of the war is like, I've seen the product markets have re-evolved. Basically, there was a lot of supply out of the Atlantic basin to the Atlantic markets. But now that has been displaced to a certain extent by the Asian refiners. And that is probably going to create a permanent freight ton mile, which is very difficult to unwind, even if the war ends. What do you think? This war has been very bullish for the product market overall?
Yeah, I think it's been pretty bullish. But some of the sort of the cream on the top, for instance, if you have an LR earning 25 versus 35, the 35 kind of earning level for an LR is transient, and it's not likely to remain perpetual. And that's transient because there was some unique bottlenecks in the European refining system through this summer, where the system lost capacity, right? So that's not a long-term sustained sort of bull factor.
Great inputs, and I think that one of the repercussions or one of the consequences of the war is like we've really seen strength in the MR sector, which we were thinking to believe that LR2s are going to replace in the long run, but it's not really happened. Yeah. Anyway, we have to quickly wind this up, and our final shot on the tanker dynamics, which I put together. Maybe you can agree, disagree, or add some. This tonnage count is balanced, or maybe in favor of owners. On paper, everything looks good, but if you see the workable ships in the market, there are very few for oil majors, refiners, traders, etc. Demand of oil consistent, unless unforeseen, such as another epidemic, a tanking of energy prices. These are the wild cards. We need to see supply disruptions. That will only trigger the market. And obviously, we need to see more rigorous CII requirements of older tonnage to slow steam. That will basically, the energy-saving devices will nudge a lot of ships to be decommissioned. If spike happens, it'll be long-lasting. May stretch until we see the new builds come in the market. To all tanker owners out there, be prepared, as chance favors the prepared mind. Anything to add?
I'll be the covered here, and I would say it's a very complicated scenario to give a good answer to. So I would encourage everybody to buy SFL stock. You can sleep sound at night. We take a long-term view on the market, good contracts. Might be a bit boring, but you'll get that quarterly dividend. Yeah.
Thank you. Anything to add, guys? That'll be all. Anybody wants any questions? Okay. He's in a hurry. Thank you.